Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Arthur J. Gallagher Co. annual report. Arthur J. Gallagher Co. provides a wide range of insurance and reinsurance services to various entities worldwide. The company operates in two main segments, brokerage and risk management. The brokerage segment offers retail and wholesale insurance and reinsurance brokerage services, including the placement of specialized and hard-to-place insurance policies. This segment also performs various activities such as marketing, underwriting, issuing policies, collecting premiums, appointing agents, paying claims, and negotiating reinsurance. In addition to these services, the brokerage segment provides expertise in areas like risk management, loss control consulting, and employer-sponsored benefit programs. The company acts as a brokerage wholesaler, managing general agent, and managing general underwriter for distributing specialized insurance coverages. The risk management segment offers contract claim settlement and administration services, including claims management, loss control consulting, and insurance property appraisal services. This segment provides these services to various entities, including commercial, industrial, public, religious, and nonprofit organizations, as well as underwriting enterprises. Overall, Arthur J. Gallagher Co. provides a comprehensive range of insurance and reinsurance services through its network of correspondent brokers and consultants. The stock price of Arthur J. Gallagher Co. has experienced a significant drop of approximately 34% to 36% over the past year due to several key events that have raised concerns among investors. One major factor contributing to this decline is the threat posed by AI disintermediation, which was highlighted when OpenAI launched insurance-native applications within its ChatGPT app library. This development has led investors to worry about the potential displacement of human brokers by AI agents capable of comparing and purchasing policies. The stock price dropped 9.4% in a single session following this announcement. Another significant event that impacted the company's stock price was the U.S. government's proposal for nearly flat Medicare payment rates for 2027. This proposal, which fell short of Wall Street's expectations, triggered a broad sell-off across the health insurer sector and resulted in a 4.7% drop in AJG's share price. Additionally, management's revised organic growth expectations also contributed to the decline in stock price. In June 2025, the company lowered its projected growth rate for the second quarter of 2025 from 6%-7% to approximately 5.5%, causing investor concern and a 3.2% drop in share price. These specific events, combined with broader market volatility and a persistent downward trend, have all contributed to the significant decrease in Arthur J. Gallagher Co.'s stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through various aspects of a company's operations. Commissions from underwriting enterprises account for 85% of revenues, while fees for services make up around 10%. Acquisitions have also had a significant impact on revenue growth, contributing approximately 7.7% to total revenues in 2025. On the other hand, certain areas have experienced decline in revenue. Brokerage revenue declined by $1.24 billion from 2023 to 2025, while management revenue decreased by $0.18 billion during the same period. Contingent commission receivables also saw a decrease, although the exact amount is unspecified. However, it's worth noting that other segments have contributed positively to revenue growth. The brokerage segment operations are a significant driver of revenue growth, contributing approximately 70% to total revenues. The risk management segment operations also contribute significantly, accounting for around 20% of total revenues. Additionally, clean energy investments have been a small but significant contributor to revenue growth. Overall, the company's revenue growth and decline can be attributed to various factors, including commissions, fees, acquisitions, and segment operations. The net income of the company experienced significant fluctuations over the years, with both increases and decreases observed in various segments. In the brokerage segment, net income increased by 84% from $2,259 million to $4,241 million due to the acquisition of Assured Partners and Woodruff Sawyer. However, in other segments, net income decreased, such as a 60% decrease from $363 million to minus $583 million adjusted. Profit margins also underwent changes, with some segments experiencing increases while others declined. In the brokerage segment, profit margins increased from 74.6% to 75.1%. However, in other segments, profit margins decreased due to factors such as reduced commission rates, volatility in premium pricing, and rising costs. The company's net income and profit margins were affected by various factors, including acquisitions, changes in market conditions, and regulatory actions. The fluctuations in net income and profit margins indicate that the company is navigating a complex business environment with multiple challenges and opportunities. The company's financial performance indicates a consistent generation of positive operating cash flow. The net cash provided by operating activities has shown an upward trend over the past 3 years, with figures increasing from $2,032 million in 2023 to $2,583 million in 2024, and further to $1,930 million in 2025. However, a closer look at the data reveals that while the company's operating cash flow is indeed positive, it has actually decreased slightly from 2024 to 2025. This decrease may be attributed to various factors, such as changes in business operations or market conditions. Nevertheless, the overall trend remains positive, with the company generating significant amounts of operating cash flow over the past 3 years. The net income figures for each year also support this conclusion. In 2023, the company reported a net income of $196 million, which increased to $177 million in 2024, and then rose again to $264 million in 2025. These figures demonstrate that the company's financial performance is improving over time, contributing to its ability to generate positive operating cash flow. The company's debt level has undergone significant changes over the past year. Initially, the current debt increased by $3.259 billion from 2024 to 2025. However, this increase was followed by a substantial jump in debt level from $1,462 million in 2024 to $15,766 million in 2025. Despite this, the total corporate and other debt only increased marginally from $13,099 to $13,298. In terms of interest expenses, there are conflicting reports. On one hand, the interest expense increased by $258 million in 2025 compared to 2024. On the other hand, interest expenses decreased from -$6 million in 2024 to -$16 million in 2025. Additionally, interest paid increased from $347 million in 2024 to $575 million in 2025. These inconsistencies suggest that the company's debt level and interest expenses have undergone significant changes, but the exact nature of these changes is unclear due to conflicting reports. The performance of various segments and regions within the company has been mixed. On a positive note, the domestic retail insurance brokerage operations have shown significant growth, accounting for 75% of brokerage segment revenues by 2025. The global reinsurance brokerage operations, Gallagher Co, and wholesale insurance brokerage operations also performed well, contributing 12% and 13% to brokerage segment revenues respectively. In terms of regions with growth prospects, Bermuda and the U.S. stand out. Bermuda is emerging as a key market for wholesale brokers seeking access to underwriting enterprises based in the region. The U.S., on the other hand, offers opportunities for expansion through ownership interests in several underwriting enterprises and a wholly owned subsidiary. However, some segments have struggled. The brokerage segment has been particularly affected, with significant write-offs of amortizable intangible assets in 2025, 2024, and 2023. Similarly, the risk management segment has also experienced difficulties, with notable write-offs in 2024 and 2023. These challenges highlight areas that require attention and improvement to drive overall growth and success. Management is emphasizing several key areas as part of the company's outlook and strategy. Firstly, they are focusing on EBITDA as an indicator of liquidity trends, indicating a strong emphasis on financial performance. The company also aims to provide long-term investment, returns greater than actuarial assumptions, and maximize investment, return commensurate with risk. In terms of growth, management expects to continue the historically favorable trend in earnings before income taxes in the foreseeable future. This is supported by the successful integration of acquired businesses, such as Assured Partners and Woodruff Sawyer, which are expected to bring significant benefits to the company. However, there are also areas that require ongoing attention and monitoring. These include the integration of acquired businesses, investment management, risk management services, and executive compensation. Management's approach to these areas will be crucial in determining the company's long-term success and financial performance. Overall, the company is positioning itself for growth and stability, with a focus on delivering strong financial results and maximizing returns on investments. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to shareholders. As per the records, the company has indeed paid dividends, with clear indications on pages 67 and 76 of the report. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares. The report confirms that the company has bought back shares, as mentioned on pages 37, 38, and 67. That concludes the financial summary for Arthur J. Gallagher & Co. Feel free to comment below, and I will be happy to answer them when possible.